Howdy, Jacob here. Today we're looking at Landstar System in the ground transportation industry. Over 6.5 billion market cap on just over 6 billion enterprise value. Growth after COVID went absolutely crazy, like a lot of other ground transportation companies, but is settling down to slightly above their pre-COVID levels. Return on invested capital has always been amazing. You love to see that. Their lowest of the last 10 years has been 20.5%. Absolutely fantastic. It looks like the company Transportation Management Solutions in US, Canada, Mexico, internationally, transportation logistics and insurance. Dang, crazy. Margins look very consistent with some of the other ground transportation businesses, but I mean, if anything, it just looks crazy consistent. Lowest of the last 10 years, 6.3%. Highest of 7.7%. They're locked in. Hopefully they're not doing anything shady behind the books or anything. But I mean, capital expenditures are zero. Like, not literally, but compared to their free cash flow, they are gushing cash flow and does not take a lot to reinvest back into the business to keep it alive through capital expenditures. It looks like their use of cash is very heavy on share repurchases, quite a bit recently in debt paydown, and then a good amount in paying their dividend. So again, I've said it before, but their dividend, a company that's increasing cash flow, buying back shares, and increasing their aggregate payout of dividend is making their dividend increase look absolutely fantastic. So if you find a company that has a very substantial percent yield, this one does not, it's just 0.7%. But if you can find one at like 1 or 2% even, and um, so you find a dividend yield of 1 or 2%, and they're a growing margin company, growing cash flow company, they're buying back shares, they're able to really increase that dividend through repurchasing shares, which bumps up the price innately through market cap staying the same, and then um, if they are increasing their aggregate dividend payout too, then it's really twofold because not only are they increasing the dividend per share, but there's less shares out there, so increasing beyond that. So interesting concept, but the use of cash is interesting. I think that it sounds or it looks like they're kind of capped out and reinvesting at these rates, and so they settle for share repurchases and paying a dividend, which is fine. I mean, if you don't have, you can have great return on invested capital and just have nothing to invest in, and maybe they're doing the best of what they have. But again, I really want this company to look at investments that they can make so that they can get hopefully those historical fantastic rates of return. So let's start making some assumptions here. I don't think it's going to be the sexiest growth numbers here. It looks fairly cyclical in negative 12% in 2019, negative 4% in 2016, but as high as like 26%, 20 minus 28% recently. I think we're going to be settling down into more comfortable and consistent numbers here. And I think that they do deserve a slight premium due to the fact that I don't think there's a lot of growth. But I personally believe that a P and price to free cash flow, the terminal estimation should be based on both growth and return on investment, as well as so many other factors, consistency with market things. There's just so many things that go into it. I think this company is very consistent. I think they have a great return on invested capital. And although the growth isn't extremely great, I think that they can warrant this type of P. And then on the margin side, it's just beautifully consistent. I like that free cash flow is higher. Let's go 5.56%. Let's buy back 1% of shares. What is that going to look like? So 6.5, 1% of shares, 65 million. I mean, they can absolutely afford that. Let's even go 2% because they've historically bought back quite a bit of shares. Their dividend right now is paying out 117 on a 5-year basis. That's probably 25, 30%. Very reasonable. What have they been increasing it in the past? Okay, I think increasing it at 8% seems reasonable to me. By the end of 7 years, maybe it'll be closer to a 50% payout. or probably not even, but especially if they're able to grow their free cash flow, I think that um, the older companies get, the more they're willing to pay on ratio of their dividend. Obviously, you don't want them paying out 80 to 90% of a consistent free cash flow, but since they're so low already, I think I can increase their dividend in excess of their um, margin expansion. But we just get to a price that's a little expensive here, which again makes sense. 25p, I'm bringing it down to 16, and their growth is just absolutely not outweighing the discount rate that I'm wanting to get on my return. And so, great company. I do think they're doing a lot of the right things. You don't have to be a sexy growth company to really give you a great return on investment. But for me, it's just not at that price point yet that's really looking attractive. Hopefully you enjoy the video and have a great rest of your day. Thank you.